We are so pleased to have on set today Dave Shea for a special segment. Now, Dave, who was the voice of the Bruins along with other people for 24 years,
lifetime ago.
Is now a financial service professional, and you work for Doyle and Minsky Financial.
I do.
Okay, so today we're going to talk about retirement planning, something that everyone should be thinking about no matter how old you are. Where does a person begin to build their retirement nest egg?
Well, ideally, Julie, you want to start as early as possible. I mean in your 20s, if at all possible. Of course, the baby boomers will tell you they weren't born in the 20s, and now here they are in their 60s, and they haven't done a great job. But ideally, start early with a methodical contribution into something. No matter how insignificant you think the amount is, because of the compounding of interest over 30, 40 years, that little amount each week is going to build into a significant amount for retirement.
Right. So you're talking about like a 401k plan with your work that's matched,
Sure.
which is a huge benefit.
That's the place to start.
Right.
You know, and the young people especially should know when they get to a company that offers a 401k, participate.
Right.
And if you can afford to, and think about separating what you can do with what you'd like to do.
Right.
You should at least contribute as much as the company matches, if the company is putting a match in, because that's 100% return on your money.
It's free money.
Before it even hits the market.
Right, right.
Now, there are other places, too, where you can go.
Okay.
You know, aside from a 401k, you can contribute to a traditional IRA. Depending on your income, you could contribute to a Roth IRA, which has great tax advantages down the road. You could invest in standalone mutual funds or stocks and bonds. You could even invest in life insurance.
Life insurance for retirement?
Yeah. Well, I
thought life insurance was when you died.
Yeah, that's the basic benefit. You die and a beneficiary
Get
receives.
your money.
Sure.
Yeah. So what is this?
Well, there are living benefits to certain kinds of insurance. Now, let's start with the basic premise. There are two kinds, basically, of life insurance.
Yeah.
There's term insurance,
Right.
which just about everybody knows and many people own.
It's good.
There's
It's
permanent
good for a
life
certain
insurance.
term.
Exactly.
That's the name.
Well,
Yeah.
that's the whole idea behind it. It's good to protect you and your family or your business for a term of time.
Right.
And the premium is usually a lot less than permanent insurance.
Right.
Of course, over time, there'll come a point where that premium will start to get higher and higher and higher.
Right.
And eventually, it gets so high that people say, I'm not going to write the check anymore for that. And so they drop the coverage. And that usually comes at a time when they're in their 60s or 70s, getting closer to a time when they would like to have the death benefit there.
Yeah, but now they don't because it was a term policy that they bought.
Sure.
So they should have bought whole life or permanent life insurance.
Yeah, and let me try to compare term versus permanent to, say, renting a house or buying a house. Okay? We rent the house. Why? Ideally, we'd like to own the house.
Right.
But if we can't afford to own the house, we rent until we can.
Right.
The premium or the rent is going to be lower, and we've got a key to the front door, roof over our head, all is good.
Right.
Eventually, the rent will go up, and we'll probably have to move. Permanent life insurance has a higher premium, as does the mortgage payment on buying a house, but you're building equity all the time you're paying those premiums. And over time, you will build up cash value in these policies that can be used while you're still alive.
Right. And a lot of people don't know that you can use your permanent life insurance as an asset in your retirement plan.
Absolutely. The thing about the cash value in a permanent life insurance policy is it's like your own personal bank. Once you've started to accumulate it, you can dip into it and either withdraw or, more effectively, take loans. Which you could put back in again. So if you needed to pull money out to help with college, you could do that. If you needed to pull money out to put a down payment on a home, you could do that. Or to help your business. And the money that grows in these policies grows tax deferred.
Right.
So it gives you some tax diversification in your portfolio, especially if other assets are going to be fully taxable all the time.
Right, right. And this is why you need a financial planner that can really put your pieces of the pie together for you. Because everybody's different.
Yeah, absolutely. Everyone is different. But it certainly helps to know how each asset class
works.
Fits. And when we go back to 2008, when we had the major crash, a lot of advisors realized that permanent life insurance really is an asset class. in and of itself because of the tax advantages
And
it has.
so few people even consider that as an
Sure.
asset. It's just like, oh yeah, when I die, my kids will get some money.
Sure.
They don't think of it as part of their portfolio.
And the death benefit is tax-free to the beneficiary.
For life insurance.
Yeah, whereas other assets may be taxable to those beneficiaries.
Right. So is taxes, is that the biggest variable that you should consider in retirement?
Well, maybe not the primary, but let's take a look at where we're at right now. Historically speaking,
Yeah.
we're in a low income tax environment. So going forward,
Think?
it doesn't feel that way in April, does it?
No.
But we are. If you go back to 79 and 80, the top
they were,
marginal
yeah.
tax bracket was
way-
70%
yeah, it was crazy.
in those years.
Yeah, that was crazy.
So if you're looking down the road to when you might retire, and income taxes in all likelihood will bump up, at
Yeah.
least we might think it will.
Right.
And you're sitting there with 401k money or IRA money that's fully taxable.
Right.
Well, you just went from thinking you're paying X amount of tax
To
Y amount of
Yeah,
tax.
right.
And that'll have a definite impact
Right.
on how long your money lasts.
So again, another reason why your whole portfolio of retirement needs to be considered.
Yeah, absolutely.
Okay.
I mean, I don't do tax or legal advice, Julie, but
Right. That's
it
almost
just
common
stands to
sense.
reason.
Right.
You need to keep one eye on how each of your assets in
Right.
the portfolio are going to be taxed when you go to use them.
Right. And in our last 2 minutes, a subject that I find so many people don't really understand is that's the whole extended or long-term health care for people in retirement. How do you fend off against that? And right now, what do people know? What don't they know?
They don't know what they don't know.
Exactly.
Is really what it amounts to. The time to start thinking about your health in retirement is before you get to retirement.
Right.
You should be asking questions like, is there a medical history in the family
Yeah.
that might impact me in retirement?
Right.
If it did, where would I turn to get the care I need?
Right.
And where would I get the money to pay for it? Once you have those answers, then you can start maybe segregating part of your portfolio and say, all right, this money is earmarked and that'll take care of any extended care needs
health.
I have in retirement.
Because there's a misconception that Medicare and Medicaid will end up just paying for everything.
Yeah,
And they don't.
we
Because
kind of treat that the way people treat all copiers or a Xerox machine.
Right,
Well,
right.
we've heard Medicare, and Medicare will take care of
everything, yeah, which is not true.
We've paid into Medicare
Yeah.
over the years, so we're entitled to that benefit. But the benefit is only for skilled nursing care.
Right. It's not so
And that's only for 100
Days, right.
A little over 3 months.
right.
People say, well, then Medicaid will take over. No, you have to qualify for Medicaid, and in order to qualify for Medicaid,
Yeah.
you basically have to spend down everything you have
right.
before Medicaid will step
Right.
in and help out.
Right. So
And-
anything you've built in your whole life is gone. And
Well,
then you might
conceivably
qualify.
could be.
Yeah.
And here's where the big concern is: if you're married and your spouse doesn't need care, but you do, you could wipe out most of the retirement nest egg,
Right.
and the spouse could live another 10, 15,
15,
20,
20
more
years.
years.
Right, right.
And
Okay.
what is he or she going to do?
Okay. So again, the whole idea is we got to plan. We got to plan.
I'll say this, and I'll leave you with this thought.
Okay.
People are not required to have life insurance or extended care coverage.
Right.
Just like people aren't required to wear oven mitts when they take a pan out of the oven, but they do.
Right.
And the reason they do is they know there's going to be pain if they don't.
Right.
Problem is, most people don't know the pain that will be inflicted if they don't have something in place to take care of any kind of care or death
Exactly.
in retirement.
Okay. Great advice.
My
Awesome.
pleasure.
Thank you so much.
My pleasure, Julie.
We thank you.